Good evening, everyone. This is Ivan from TradeFloor. Today it is Graham O'Brien from the ASX, and myself, Patrick, is unfortunately unable to attend. So, Graham, I hope you can hear me. Let's kick this off.
Yeah, for sure, Ivan. Good to be joining you again. So,
for the third time.
We're going to be looking at some market makers in our options market today, and I think we're going to be going through some trading strategies for on the platform. Is that correct?
Correct. Yes.
Perfect. So, we've been through a couple of sessions so far, and intro to options, and some more advanced strategies. But more often than not, when you're trading in the options market, you're actually trading a market maker. So, understanding what they are in the market for and what they are trying to do in the market, making money when they're trading as well, helps us in being better traders ourselves. So having a good understanding of how they trade can help us. I'm not sure if I have got access to these slides as yet, Ivan. Oh, it looks as I do.
Yep, and just one second as well. You are dropping out a little bit, just so you know. So if you're
I'm not
speaking to the mic.
Hopefully my Wi-Fi can keep up with it today, so we'll see how we go. But as usual, everything that we're talking about in these sessions is general advice in nature.
Thank you for giving the disclaimer. Alrighty, cool. Off to you.
So just to recap, options. When we're thinking about options over shares or equity options, they're a contract size of 100 shares per contract. They expire on the last Thursday of the month, but very importantly, that's only up until June of next year. After that point in time, it will be the third Thursday of the month, and I'm sure you can actually see that already in the game. If you wanted to select more longer dated, you can see a different expiry date rather than the last Thursday of the month. Equity options have two different styles, American style and European style. The American style options you can exercise on any day up until expiry. European style options you can only exercise on the expiry day itself. And all equity options are physically settled. Index options, on the other hand, they trade in dollars per point. So index of around 6,700 points will be worth $67,000. They always expire on the third Thursday of the month, and they're always European in style. And instead of expecting you to physically settle 200 different shares for the S&P ASX 200 index, they're all cash settled. Now, we do have some of our stock options, 10 of them in fact, that have expiries every single week, and the index also have expiries each and every week. So if we're thinking about options, and before I move on to those trading strategies, just to recap again, when we're buying an option, you always have a right when you buy options. You don't have an obligation. When we're buying a call, we have the right to call on that stock to buy it in the future. When we're buying a put option, we have the right to put the stock to someone else or sell it to them in the future, whereas sellers of options always have obligations. Sellers of calls are obligated to sell, sellers of puts are obligated to buy in the future. That's a quick recap on some of the stuff that we've done in those previous two sessions, Ivan. So let's have a quick look into market makers and why do we have our market makers in options markets? And really, unlike the stock market where there's often lots of buyers and sellers when it comes to companies on the ASX. When it comes to options themselves, there's 40,000 odd different series on each stock that we have options over. The likelihood that someone is going to be wanting to at the same time that someone else in the natural marketplace is going to want to sell that is remote. So we need market makers to help provide liquidity to the options market. But as traders, we need a decent understanding of what market makers do for us to be able to profit in the market. One of the very first things that we need to understand is market makers are obligated by us at the ASX, but they're not obligated for the full trading day. We know that the single stock options market opens at 10 a.m. in the morning and trades through until 20 past 4. However, market makers aren't obligated until 20 past 10 in the morning, and the obligations cease at 4 p.m. Ivan, I think that's one of the main reasons why we don't actually start the trading in the options game until 2020, isn't it? Because we don't have market makers.
That's correct, yes.
Yeah. When it comes to index options, on the other hand, they open at 10 a.m. or their obligations open at 10 a.m. and they trade through until 4:30. For those of you that trading in the physical options market, you can actually ask quote requests from your note on the screen. Market makers are obligated to respond to quote requests within a 15-second time period in any expiries up to 12 months. So even if you don't see a price on the screen, you might like how tight the price is on the screen, make sure you ask quote requests. They have to respond within 15 seconds. Market makers alternatively do actually have to quote on a continuous basis. In our top 20 option stocks, we have to quote in 48 different series throughout the trading day, in 8 calls and 8 puts in 3 of the next 6 expiries. For stocks that are a little less liquid in the market, or at least in the options market, you need to quote half that amount. 24 series in 4 calls and 4 puts over 3 of the next 6 expiries. How much they have to quote and what the spread can be is really determined on an individual. And we help you in understanding what that individual basis of the minimum quantity and maximum spread via the ASX website actually provides you with a list of market makers that are obligated in the stock, but then importantly how much they will actually have to put in as a minimum quantity and what's the maximum spread that they can put on the screen. Importantly, market makers have to respond to both quote requests and continuous obligations, and they need to meet that at least for 70% of each trading day in the market. You may be wondering to yourself, well, why would market makers even bother with this obligation? What are they getting in return for that obligation? Market makers are contracted by us at the ASX to provide that liquidity, as I said before. But the real reason they are making markets is they want to make money. They're trying to buy it and sell it high. A market maker would be lying if they said they weren't in the options market to actually make money. But what helps them in making money is the fees that ASX charges market makers is much lower than the fees that we charge normal traders in the marketplace. For a single stock option, for instance, ASX charges 13 cents per contract for trading in those options, whereas market makers pay as little as 1 cent per contract. Now you might be thinking to yourself, well, it just sounds easy, you just buy that option low and just sell that option high, but it isn't as simple for a market maker because there is often no one buying that option at the same time someone is selling it. They are running risk that someone else might want to sell that option to them if they've obviously originally sold someone else. What happens is the liquidity in each individual option series is not the same. So instead, the market makers try and run a flat book, and they use this thing called delta hedging to dynamically hedge their book to ensure that they don't lose if the market moves up or down in the underlying shares. In actual fact, market makers aren't really trading direction of which way they think a stock will move up or down. They're actually trading volatility, and they're trying to buy volatility low and sell volatility when it's high. The way they can ensure that they're not trading a view on the stock is through delta hedging. And we're going to have a look at it. So delta of an option is really telling us how much that option will move for an equivalent movement in the underlying share. So an option with a delta of 1 moves 1 for 1 with the underlying share price. A delta with 0.5 half as much as the share price itself, whereas a low delta option of say 0.2 will only move 1/5 as much as the share prices themselves. I also like to think about delta of whether the options at in or out of the money. And in the money option, so if we exercise, we're actually making money at that particular point in time, tends toward a delta of 1. And at the money option tends towards a delta of 0.5, or an out of the money option tends towards a delta of 0.2 in this particular case. If I'm thinking as a market maker, my risk in the market, if I go and buy a call option as a market maker, my risk is the market would actually fall because I'm long a call option, I want the market to go up. So if I short sold 100 shares in a delta 1 option, I'm actually hedging myself against a fall in the market for that particular option. Whereas if it's an at the money option, I know it will only move half as much. So the market maker to hedge their risk of buying a 0.5 option or an at the money option will be to sell 50 shares instead. And as you can see, as the delta falls, it would reduce the amount of shares that they would sell over a call option. Vice versa, if they've bought a put option, the risk is obviously that the market, in that case, they would be buying 100 shares for that deep in the money one delta option, buying 50 shares for a 0.5 delta option, and 20 shares for a 0.2 delta option. Sorry about that, Ivan. I didn't even turn my phone on to silent.
That's all right. A few people are saying that your sound is dropping out a fair bit.
Yep.
Is it your Wi-Fi? Is it?
Yeah, I think it could be my Wi-Fi. I'm on about 1 bar on 4G at the moment. I'm in and out about travelling at the moment. So hopefully it keeps on coming in and out.
Well, hopefully it just stays in more than out. But yeah.
We'll see how we go. We can always do a re-recording tomorrow if we have to.
Yeah, I think we might have to, but that's okay. Let's see what sound we get.
Yep. If I think about delta hedging as a market maker, if a trader has a delta on that options portfolio of 0.5 on Monday, the market maker would sell 50 shares to hedge their portfolio falling in value or their option value falling in value. Let's say that overnight the market goes up and the delta moves to 0.6 on Tuesday. All of a sudden the delta of that option's changed, so the market maker needs to sell an additional 10 shares to hedge against that large position. But they're selling those 10 shares $10.50 rather than the $10 they originally sold those shares at. And they're dynamically hedging that options position over time. After the market goes down, let's say it does, and the delta moves back to 0.5 on Wednesday, the trader doesn't need those additional short sold 10 shares, so they buy back those 10 shares and then actually make a profit on that trade. They sold 10 shares at $2.50, buying back at $10, and made a profit of 50 cents. In actual fact, through this delta hedging, the market maker is really trying to make more money out of that delta hedging transaction than what they originally paid for the option in the first place. They're trying to buy volatility low in that case and make more money out of the share trading. Whereas if they sold the option, they'll be trying to make more premium out of the market than they lose through their hedging transaction in that particular case. In all cases, those market makers are trying to buy low and sell high. So if we start thinking about what does that mean for us as traders, first of all, we need a liquid stock because market makers hedge against physical stock for their exposure in the options market. Further, when we start thinking about when are times when the market's quite volatile, it's when the market opens. So that's why you probably should wait before you start trading in the market. And then finally, the other time where options deltas change quite radically is very close to expiry. An option can actually flip very close to expiry from a 0 delta to a 1 delta. So a market maker will have to dynamically hedge lots and lots of shares over that period of time. So we take on board that as traders in options markets to really not trade very, very close to expiry because it may mean we get very poor prices from the options market makers. Hopefully that's given you some basic understanding of how some of the ideas. Always ask a quote request to the market maker regardless of how you're trading. Secondly, try to steer clear of trading around market open because markets can be quite whippy. It can be difficult to get a decent price from the market makers due to their hedging issues. And then finally, if you're rolling transactions or you're trading close to expiry, make sure you're in the morning on an expiry day, not very close to that forward close. Hopefully that's given you some basic understanding of how market makers work in the market anyway. So Ivan, back to you. If we've got any questions, happy to answer them now, but then I'll leave the rest of the presentation with you.
Thank you for that. I think that there's the majority of the feedback was just that they missed out on some of the crucial bits. So we may have to redo the session again at a different point in time. So we'll chat about that tomorrow. Sorry, you might have to say that one again. Sorry.
Sorry, I gave it my best try to get this Wi-Fi working. I even moved it higher in the sky, but it doesn't seem to have worked at all. So how about we record this part, but you continue on with trading strategies?
Yep, definitely.
Okay.
So I'll, no worries, enjoy. So thank you for everybody who's still on the line and listening to what we're talking. So just in terms of, one question did come up in terms of what did Graham say around trading close to expiry. Because you're trading against market makers, the idea is that you really want to be trading when there's just a little bit of enough, well, when there's enough time to get out of your trade. So you don't really want to go on and trade in the last couple of seconds before the stock actually, well, before the expiry date. So if you're generally trading, what I generally do is I keep to trading around about the Tuesday or the Wednesday, Wednesday being sort of the latest that I would be closing out unless I really, really have to, and just before that Thursday expiry. So just make sure. Okay, so what I'm going to do is I'm going to quickly jump to the game. Any questions that you have, obviously might be a little bit tricky in light of what most of you haven't heard, but let me know if you've got any questions around the game or around anything that Graham's spoken about. There is a whole video as well as part of the 10 by 10 that does talk about what market makers provide and what they help with. And the kind of support that they provide for the market. So that's, I think, video 7 or 8. If you're not getting the 10 by 10 videos, the 10 daily 10-minute videos that start with talking about how puts and calls can impact your portfolio to then ultimately trading spreads and other strategies. So if you're not getting those, let me know. And as I said, if you've got any questions, please let me know. So what I want to do is I just want to look through a couple of strategies with you, some of the strategies that we like when we're trading, and also have a look at the leaderboard. Although based on the leaderboard from last week, there hasn't been a whole heap of change. I mean, I don't think I've ever seen a player turn 50,000 into 837 so quickly, and some really great performers across the entire spectrum of traders. In terms of a question from Kenneth, how do I get the videos? The videos you can get, so when you've signed up for the game, you would have received them. If you're not receiving those, I can go on and ensure that I enroll you. So they come from my implied volatility email. That's ivan.shurilov@impliedvolatility.com.au. If you haven't been receiving those, let me know. I can get you on that mailing list. All right, so again, from last week when we spoke, the market fell a little bit further on the next day. We're talking about what that would mean for the leader, and he ended up significantly improving. So in terms of some of the trading strategies that we were speaking about before, so I just had a quick look in there. Yep, so Kenneth, just if you want to get into the game, you can sign up at optionsgame.com.au. The game goes till the end of this month. Usually at this point in time, I would say that there's plenty of opportunity to win, but in reality, probably not after the performance of the number one player. So I'd put that out there. All right, so a lot of the trading that, as Graham mentioned, is done on the XJO. That's the most common trading instrument in the market. The XJO in itself is the top 200 stocks in the market, and that's why it's usually a really good way to get exposure to an entire index of the top 200 stocks. So with options, you can obviously take a view on a directional trade, so whether you think that the XJO is going to go up or down, or neutral. A lot of the trading that we see coming through our platform, so on top of the game, obviously we've got the same experience in impliedvolatility.com.au. So for anybody who's looking at trading, the majority of our trading comes through is generally neutral on the index, where people bet that the market isn't going to go anywhere. Now, we've spoken about this strategy last week, and I just want to go on and rehash this because this is a strategy that ultimately is not too dissimilar to how market makers are generally trading. So you're synthesizing the portfolio in somewhat. So when you're going into looking at coming up with an options strategy, we've got a whole heap of them here in the options cookbook. One of these strategies is you can go and say, sorry, that's the wrong one, neutral. in terms of price. So there's a whole heap of strategies that you can take if you want to take a directionless neutral view on the market. The Iron Condor is a trade that we do. So we were talking about the short straddle and the short strangle last week. The Iron Condor, the way that that works is it buys an out-of-the-money put and a call to effectively give you some protection as well in the case of the market doing something unexpected. So with a lot of these strategies, if you're looking to learn some strategy that you haven't learned before, or especially for those that are sort of probably in the intermediate levels, you can always click Learn More and you can get an understanding of when you can run these strategies, the maximum profit, maximum loss, and what the time decay is doing for you. So let's create the Iron Condor. The first thing that you'll get is a date. So generally, the sweet spot for options is around about 45 days. So in the majority of what we're trading, you want to be really sitting around that 45-day range. So you're not always going to be able to pick a expiry exactly at that time, but you want to be looking around, especially if you're selling strategies like trading Iron Condors or anything that is a credit strategy, which is money that you're receiving. You're looking to find the closest date to that. So let's go and click Create Strategy. And by default, all of our algorithms and our calculations start coming up and giving you a sort of an optimized, to some extent, an optimized strategy that you can utilize. In the case of this, sorry, we've got a couple of other buttons on here, which is for sharing and distributing strategies, which you're not going to see on your screen, but the main screen is exactly the same. So when we're looking at the strikes, by default, the strikes are picked using a standard deviation calculation, and that is we're looking at a optimized strategy to help you get the most amount of premium from the market in return for sort of the optimal chances of performance. Later on, probably now, early next year, we'll run a special webcast talking specifically around Iron Condors. We spent 9 months with our quants studying how implied volatility impacts these strategies and how the statistics work around the strikes that we're picking. So there's a lot of work that's gone in behind the scenes to picking when you click that particular button in terms of picking the strikes that get selected. So based on the numbers that we've got right now, and based on what the market is pricing options at, the strikes that come up for the index are 65.75 and 68.25. So we know that there is a pretty high chance that the market is going to stay between 65.75 and 68.25 between now and the 16th of January next year when the expiry date is on. In the case that it doesn't, and the market goes either significantly down or significantly up, we want to put in these inherent stop losses, which is 64.50 and 69.50. So anywhere below 64.50 or anywhere above 69.50, we're effectively tapping out our loss. So if we're looking on the right-hand corner here when we're creating the strategy, the maximum profit, maximum loss, the maximum profit is going to be $513 for every one lot that we do. So that means that one lot of this means one of these, sell one of these, sell one of these, and buy one of these. Right? So if we wanted to go on and say do 2 of these, what would happen is we'd be trading 2 of these, sell 2 of these, sell 2 of these, and buy 2 of these. Now, what Graham was talking about before is the combination trade. So in our platform, we actually let you trade not only in the game, but also in the real platform. From this point in time, usually what you would have to do is you'd have to call up a broker and say, okay, these are the trades that I want to do, combine them together, and then ultimately execute them in the market. With that platform, from this point in time, you can actually go on and create the combination straight from here, click Execute Strategy, and it'll come and give you a price as well. Most combos that you do with XJO will typically in the real market come back with a market maker price. In this case, although the market's closed, our algorithm is suggesting it's somewhere between 52 and 50. In the real market, you'll typically get a slightly wider quote, but the XJOs will typically go in and say, here is the price that you need to trade at, and we utilize this theoretical price to give us a pretty good indication as to where to trade. Now, with all brokers that you're trading through, Graham's always suggesting to go on and do quote requests. In our platform, we actually don't do quote requests whatsoever, because what we've done is we've taken everything like everything else we do sort of to the next level. So we've got these ETR ranges. So they're called the estimated trading range. An estimated trading range will give you a price guide as to where market makers need to quote. So based on all of the algorithms that we've been working on over the last 6 years, there is something that is going to give you a very good indication as to where you should be trading. In this case, what it's saying is the market maker will have to trade against you somewhere around about 57 and 45 credit. Now, if you do trade around about the theoretical, that 51 point level, your maximum profit is going to be now $1,000 because we're trading two lots, so two whatever we had before. And the maximum loss on this trade, so if it goes below 64.50 or above 69.50, is going to be around about that $1,500. We get a buying power, which is really how much this trade is going to impact our portfolio, and some break-even values. So we know that the underlying price of XJO cannot go lower than 65.24 or higher than 68.76 before we start losing money on this trade, excluding fees of transacting. So when we're looking at trading strategies, this screen is important regardless of what strategy you're trading. This screen makes it extremely simple to understand what we're doing and how we're doing it. The next thing that I'm going to, and also by the way, obviously if you've got any questions, please let me know. But I'm going to tell you a little bit more about the payoff diagram as well. And so one of the things that we looked at here was in the options cookbook, you would have noticed that there are sort of these small little payoff diagram views. And these are very important to understanding what it is you're trying to achieve and how does this payoff diagram relate to what your view is of the market. How are you using options to express your views in the market? So in this case, for example, the way that we read this is the current price is around about 67.18, so that is right here in the middle. And then as we go up, we can see how our profit goes higher or how it goes lower. So anything above the zero line will mean that we're profitable on the trade. Everything below will mean that we're losing on this trade. So if we just looked at the expiry date itself, and there's a bit of a rounding around this, but if we just looked at the expiry date of this underlying trade and just this orange line on the 16th of January 2016, we can kind of see exactly the same information as we're seeing from these break-evens. So we really, the 65.24, the 68.76, they're both right here, right? So that's your 68.76 and that's your 65.24 right over here. So if we go into the options cookbook and we were looking at the Iron Condor, you can see that the image, I'm not going to hover over that, but we can see that the image is showing us exactly that. There are 4 points, A, B, C, and D, and we want the price to be somewhere in between B and C for maximum profit and be closer to B if it's below B and higher than C if it's below C, if it's between C and D. So that's demonstrated by the green point. In all of these payoff diagrams, the value that you're looking at or the current price is sort of in the middle of an, if you call it an X, right? So straight down and straight across. So in this case, for example, that right here is the middle of that X point. So this is where we are right now. Everything higher will give us profit. Everything lower will give us a loss. Everything to the right will start having a negative impact. Everything to the left will also have a negative impact, and we want it to be as close as possible to this on expiry date. What these additional values show us is how exactly is time decay going to start impacting our portfolio. So if the market doesn't go anywhere between now and the 16th of January, over the next 19 days, we're going to make $334 in this trade. And then in the last 19 days of the trade being live, we're going to make almost double that again. And that is generally how options work. As we get closer to expiry, as time decays, options start eroding faster and they start impacting your profitability more and more. So whatever strategy you're looking at, the easiest place to go on and find this is to go into the options cookbook, to go on and filter by whether you're bullish, bearish, uncertain, or neutral on the price, whether you think that volatility is going to go up or down, which you're going to get through that IV rank. And again, if you're getting these videos, we explain a lot about IV rank. If you want me to give you a quick explanation now, let me know. And from there, you can go on and start crafting these strategies. Question is, how does getting into the orange slope affect margin availability? It depends on the different strategies. So in the case of an iron condor, the best way to look at any kind of a margin scenario is really to look at the maximum loss. So unless you've got and this really comes back to your margin, this really comes back to your broker ultimately, but with most brokers, I guess, well, let's look at the ASX margin specifically. So the maximum loss should be equivalent to the amount of margin that you're going to have to pay. So although in this case we need to pay $1,000 to put this trade on, you really need to have $1,500 in your bank account to account for potential margin spikes. Trading strategies like iron condors, I'm not sure if all of you were in on the webinar that we did last week, but we spoke about margin and how that works. And it effectively works on 16 worst case scenarios. So depending on where you are with that loss, your margin effectively will go somewhere from $1,000 to $1,500 as it gets closer to expiry, as the risk starts picking up in that erosion in the case of an adverse move. And then ultimately, once you're sort of out into areas around here, your margin will no longer have any impact. The general thing that will, so for actually going one step back, for our online trading platform, we use Pershing. Pershing is one of the major clearers in the market globally, and they impose a 1.2 times margin multiplier. So what this means is that on top of the ASX margin, they will ask for a 20% buffer. Different places are different. So online brokers typically will ask you for 2 times the risk of the overall maximum risk, and then they'll also ask sort of one-time premium or some combination of both of those, somewhere between 1 to 1.5. Every single broker's got different requirements. So in our case, the most amount of margin that you'd have to pay is 20% more than 1.5 thousand in this case. So that value. Generally, when we're trading, our clients generally don't have any problems with that, because the way that we approach trading is if you've got called $10,000 that you've contributed to your bank, then we're saying, well, you know, your trade's probably going to be somewhere around about $1,000 in maximum loss. So you're never really getting into those margin call situations. Obviously, trading is different for everyone and how much you want to risk and what kind of reward you're looking for. But we generally don't really have a lot of people getting to margin call because we are talking about quite conservative levels of trading. So hopefully that answers your question. So when you're going in and looking, and this is a great opportunity to continue practicing some of these trades, and you know, you've got another couple of weeks to go on and get the most out of it. You can go on and play around with different strategies and just get a bit of a feel for the kind of power that you can get through using this particular screen. The most important thing that I will highlight is, again, keep looking at the maximum profit, maximum loss, the break-evens, and how that impacts your trading overall. Another thing that I'll also say is that, you know, this is a great opportunity to jump into the back testing, which is one of our sort of more advanced features, and you can go in and see how different strategies would impact over time. So for example, if you're looking at a neutral strategy and you want to go and compare, I'm just going to add XJO, for example. And so I just typed in XJO, and I'm going to go in and pick a time, call it January 2019 there. And then from here, you can see, for example, what the impact would be if we went and picked oh, I think my screen doesn't like me anymore. Typically what would happen is when you click a cookbook, you can go on and pick different strategies. So you can go and see how an iron condor, for example, would perform versus a short straddle or vice versa. So you can go on and play around with some of these strategies, getting the exact same view as the cookbook. So unfortunately, I'm not going to be able to show it to you now, but you can go on and play around with this in your own platform. Another question from, so if you're at a max loss a session or two before expiry, do you close out still? So in the education portal, and I will give you this answer in a second, but in the education portal, you get access to a lot of these videos. One of these is in the intermediate video in the courses. There is a video on options, assignments, and exercises. I highly recommend you watch this because that gives you a visual view as to what to do in the event of the market being in a maximum loss. So, but to answer your question, if we're looking at an iron condor, like we were looking before, the iron condor is not really at a maximum loss unless it's significantly gone against you until the very last day. So in some situations it may make sense to go on and close it out beforehand to minimize the loss that you're taking, but it really depends as to where it's at as well. So if, for example, the trade is just underneath your sold leg, you might want to be considering to go on and close down just a sold leg around about the day on expiry date. It always comes down to your view of the market and whether you think that it's going to be there. One way to go on and see if the market is agreeing with you or not is to utilize what is called the delta. And we've spoken about the delta a little bit, in some cases quite significantly, but one way that you may not be aware of using delta is utilizing it as a gauge for probability. So if we go in over here and say, I want to have a look at an XJO strike, which is in this case 6,700, expiring on the 19th of December 2019, which is right over here. So if we looked at the 6,700, the 55.6 delta means that there is about a 55% chance of that option expiring in the money. Now it's a bit of a crude way of looking at it, but nevertheless there is some correlation between those, some serious correlation between those two. So if you're looking at a 67.25 put, for example, which is slightly in the money, there is a 52% chance of that stock, of that underlying option ending up in the money. So that sort of gives you a little bit of an indication as to a way of understanding the probability around trading, and then it sort of helps you to make a decision around whether you should be closing or not closing a particular option. All right, guys, so I've just run you through it in a bit more detail around how to do the strategy. Are there any questions that you guys have at this stage? Otherwise, I apologize for the sound that we had initially where Graham was dropping out. We will figure out a time when we can reschedule this with everybody involved, and we can hopefully run that probably next week or so, so that you can actually get a lot of the information that you missed out on. All right, guys, if there's nothing else, I thank you all for attending tonight. We'll send out some correspondence in the next day or so with the next time. We hope you can join us then, and by then the sound qualities will all evaporate. Thank you all. Have a great evening. Thank you all for joining us. We'll catch you next time.